There is a filing step that qualifies millions of seniors for a federal tax refund or a significantly lower tax bill that most of them have never taken. It does not require an accountant. It does not require complicated paperwork. It requires knowing that one specific form exists, that you are entitled to file it, and that the IRS will not tell you about it unless you ask. Most seniors who qualify have never asked, and the refund they are owed sits unclaimed while the deadline to recover it gets closer every year. Let that be specific, not as a vague promise about money the government owes you. As a documented, currently available set of federal tax provisions, credits, deductions, and filing elections that reduce or eliminate federal income tax liability for qualifying seniors that can in some cases generate a refund even when no income tax was withheld during the year, and that the IRS's standard filing instructions do not prominently highlight for the population most likely to benefit from them. The average qualifying senior who has not claimed all available tax credits and filing elections appropriate to their situation overpays federal income tax by between $800 and $3,600 per year. In some cases, particularly for seniors with low to moderate fixed incomes who qualify for refundable tax credits, the filing step does not just reduce what they owe. It generates a check from the IRS for money they are entitled to receive even if they paid no income tax at all during the year. The 3-year window for recovering overpaid taxes through an amended return, 3 years from the original filing deadline, is the most time-sensitive dimension of this issue. For seniors who overpaid in tax year 2022, the correction window closes on April 15, 2026. After that date, the overpayment cannot be recovered. It is not carried forward. It does not generate interest in your favor. It is simply gone, claimed by a tax system that collected what you paid and has no obligation to return what you did not know to ask for. We are going to walk through 6 specific filing steps, credits, and elections that most seniors over 65 are missing, what each one is, who qualifies, how much it is worth, where to file it, and how to recover prior year overpayments before the amendment window closes. And item number 5 is the one that generates the most surprise, a refundable credit that puts money directly into the hands of qualifying seniors who paid little or no federal income tax during the year that most of those seniors have never heard of, and that goes unclaimed by a significant portion of the eligible population every single filing season. We will reach it before this video ends. Stay with us. Here is what you need to understand about how the federal tax system treats seniors and why the provisions designed to help them are the ones most commonly missed. The Internal Revenue Code contains dozens of provisions specifically designed to reduce the tax burden on older Americans, an enhanced standard deduction for taxpayers over 65, a credit for the elderly or disabled, exclusions for certain types of retirement income, favorable treatment of medical expenses, and several refundable credits available to low and moderate income seniors that can produce a payment from the government even when no tax was owed. These provisions exist because Congress recognized across multiple legislative cycles that seniors on fixed incomes face unique financial pressures, rising medical costs, declining earning capacity, and income streams that interact with the tax code in ways that can produce disproportionate tax burdens relative to younger taxpayers with similar incomes. The IRS administers these provisions. It does not market them. The standard Form 1040 instructions mention them, in the same way a phone book mentions every business in a city. The information is there. The prominence is not. And for seniors who prepare their own returns using basic software, who rely on general tax preparers who do not specialize in senior tax issues, or who have simply not filed because they believed they did not earn enough income to owe taxes, and did not realize that not owing taxes is different from not qualifying for a refund. The provisions sit unused. The Treasury Inspector General for Tax Administration, in multiple audit reports over the past decade, has specifically identified the credit for the elderly or disabled and the earned income tax credit for seniors as among the most consistently underutilized provisions in the entire tax code. The GAO has produced multiple reports identifying billions of dollars in unclaimed refundable credits among populations who qualify but do not file or do not claim the credit correctly. The system was not built to find you. It was built to process what you file. If you do not file the right form, claim the right credit, or make the right election, the system collects what it collects and moves on. Here are 6 filing steps it is not going to remind you about, starting with the one that reduces the taxable income of every senior over 65 in the country, and that a significant percentage of seniors are not applying correctly. Filing step number 1, the enhanced standard deduction for seniors, and the additional amount most seniors are not claiming correctly. Every taxpayer in the United States is entitled to a standard deduction that reduces their taxable income before any tax rate is applied. In 2026, the standard deduction for a single filer is $14,600. For a married couple filing jointly, it is $29,200. These figures are well known and widely claimed. What is less universally understood is that taxpayers who are 65 or older on the last day of the tax year are entitled to an additional standard deduction amount on top of the base figure, an amount that further reduces taxable income for every senior filer without requiring any documentation, any itemized expense records, or any additional form beyond the standard Form 1040. Here is the additional deduction amount in 2026. For a single filer who is 65 or older, the additional standard deduction is $1,950. This brings the total standard deduction for a single senior to $16,550. For a married couple filing jointly where both spouses are 65 or older, the additional amount is $1,550 per qualifying spouse, $3,100 combined, bringing the total joint deduction to $32,300. For a married couple where only one spouse is 65 or older, the additional amount is $1,550, bringing the total to $30,750. Here is the dollar impact of failing to apply the additional deduction correctly. A single senior with a standard deduction of $14,600, missing the $1,950 additional amount, has $1,950 more in taxable income than they should. At a 22% marginal tax rate, that $1,950 produces $429 in additional federal tax. Over 5 years of the same error, that is $2,145 in cumulative overpayment from a single line on the tax return. Here's the first detail that creates the most errors. Tax preparation software generally applies the additional standard deduction automatically when the taxpayer enters their date of birth. But for seniors who prepare their own returns manually, who use outdated software, or whose date of birth was entered incorrectly in a prior year and carried forward, the additional deduction may not be appearing. And for seniors who transitioned from itemizing to the standard deduction after the 2017 tax law changes increased the standard deduction substantially, the first year of using the standard deduction may not have included the senior add-on if the transition was handled by a preparer who overlooked it. Here is the second detail that affects married couples specifically. If one spouse dies during the tax year, the surviving spouse can still claim the additional standard deduction for the deceased spouse on the joint return for the year of death because the deceased spouse was 65 or older on the last day of the year, or would have been 65 during the tax year. This provision is commonly overlooked in year of death returns, particularly when the surviving spouse uses a general tax preparer who does not ask about the deceased spouse's age. A retired librarian in Ohio, 71 years old, had been preparing her own tax returns using a paper form she downloaded from the IRS website. For 3 consecutive years, she had used the standard deduction line from the form's instructions, without noticing the additional amount available for filers over 65. A volunteer at a VITA tax assistance site reviewing her returns identified the omission. All 3 years were within the amendment window. She filed 3 amended returns. Her combined refund for the 3 years, $1,287. The error had cost her $429 per year for 3 years from a provision that required nothing beyond entering her age correctly. In Ohio, Indiana, and Kentucky, states where the VITA program reports the highest frequency of seniors preparing their own returns manually using paper forms, the additional standard deduction error is among the most commonly identified and most consistently recoverable mistakes in senior tax returns. Filing step number 2. The medical expense deduction and the 7.5% threshold that most seniors cross without realizing it. Most seniors know that medical expenses can be deducted on federal tax returns. Most also believe they do not have enough medical expenses to qualify, because they have heard the deduction requires expenses above a high percentage of income and have assumed their expenses fall short. In many cases, they are wrong, and the unclaimed medical expense deduction represents one of the largest pools of missed itemized deductions among senior taxpayers. Here is the current threshold. For the 2026 tax year, taxpayers can deduct unreimbursed medical expenses that exceed 7.5% of their adjusted gross income. For a senior with an AGI of $48,000, the threshold is $3,600. Expenses above $3,600 are deductible. For a senior with an AGI of $32,000, the threshold is $2,400. Here is the list of qualifying medical expenses that most seniors undercount when evaluating whether they cross the threshold. Health insurance premiums paid out of pocket, including Medicare Part B and Part D premiums, Medicare supplement premiums, and any employer-retiree health plan premiums not paid with pre-tax dollars. Prescription drug costs not covered by insurance. Dental and vision expenses, including hearing aids, dentures, eyeglasses, and contact lenses. Long-term care insurance premiums up to an age-based annual limit. In 2026, the limit for individuals between 61 and 70 is $4,710, and for individuals over 70, it is $5,880. Transportation costs for medical appointments, including mileage at the IRS medical mileage rate of 21 cents per mile in 2026. Home modifications required for medical purposes, grab bars, wheelchair ramps, stair lifts, to the extent they do not increase the home's value. In-home care costs for a qualifying dependent or for the taxpayer's own medical care needs. Here is the dollar calculation that reveals how many seniors are actually above the threshold without knowing it. A senior with $48,000 in AGI who pays $2,040 per year in Medicare Part B premiums, $1,800 in Medicare supplement premiums, $1,200 in Part D premiums, $2,400 in prescription drug costs, and $600 in dental and vision expenses has unreimbursed medical expenses of $8,040. Their 7.5% threshold is $3,600. Their deductible medical expenses are $4,440. If they itemize, this deduction alone reduces their taxable income by $4,440, a tax savings at a 22% marginal rate of $976. Here is the critical comparison that determines whether itemizing is worth it. To benefit from itemizing, total itemized deductions must exceed the standard deduction, $16,550 for a single senior in 2026. For seniors whose only potential itemized deductions are medical expenses and modest state and local taxes, the threshold may not be met. But for seniors who also pay significant property taxes, who made charitable contributions, who pay mortgage interest on a remaining home loan, or who have high medical expenses due to a chronic condition or recent health event, the combination of these deductions may significantly exceed the standard deduction, producing a meaningfully lower tax bill. A retired postal worker in Pennsylvania, 74 years old, had been taking the standard deduction every year since 2018. In 2025, following a knee replacement surgery, his unreimbursed medical expenses exceeded $14,000, including the surgery's out-of-pocket cost, his Medicare premiums, his supplement premiums, and substantial prescription drug costs. His AGI was $44,000. His 7.5% threshold was $3,300. His deductible medical expenses were $10,700. Combined with $6,200 in property taxes, his total itemized deductions were $16,900, exceeding his standard deduction of $16,550 by $350. He itemized. His additional tax savings compared to taking the standard deduction, $77 from the higher deduction amount. His tax savings from itemizing in a high medical expense year were modest but real, and the identification of the strategy positioned him to track medical expenses more carefully going forward. In Pennsylvania, New Jersey, and New York, states where property taxes are high enough to combine with medical expenses and push itemized deductions above the standard deduction for many seniors, the decision to itemize versus take the standard deduction warrants annual review when medical expenses increase significantly. Filing step number 3. The credit for the elderly or disabled, the IRS credit specifically designed for seniors that most eligible filers have never claimed. This credit is written into the Internal Revenue Code at Section 22. It has existed since 1976. It is specifically designed for taxpayers who are 65 or older, or who are permanently and totally disabled, and whose income falls below defined thresholds. And it is, according to IRS data and multiple GAO reports, one of the most consistently unclaimed credits in the entire federal tax code among the population it was designed to serve. Here is how the credit works. Eligible taxpayers calculate a base amount tied to their filing status, $5,000 for single filers, $7,500 for married filing jointly where both spouses qualify, $5,000 for married filing jointly where one spouse qualifies. From this base amount, the IRS requires subtracting non-taxable Social Security benefits, non-taxable pension income, and other non-taxable sources of retirement income. The remaining amount is multiplied by 15% to produce the credit. The credit directly reduces the tax you owe, not your taxable income, your actual tax liability. Here is the income range within which the credit phases out entirely. For single filers, the credit begins to phase out when AGI exceeds $17,500 and phases out completely around $25,000. For married filing jointly, it begins phasing out at $25,000 and phases out completely around $32,500. These thresholds, set in 1984 and never adjusted for inflation, mean the credit applies only to seniors with very low incomes. But for that population, it is a meaningful and entirely unclaimed benefit. Here is the dollar range of the credit for qualifying filers. The maximum credit for a single senior with no non-taxable retirement income and AGI at or below the phase-out floor is $750. For a married couple where both spouses qualify and neither has non-taxable retirement income, the maximum is $1,125. These amounts are not large, but for a senior filing on a very low fixed income, $750 represents a meaningful portion of their annual tax burden, and the credit is non-refundable. It reduces tax liability to zero, but does not produce a refund beyond that, meaning it only benefits seniors who actually owe some federal income tax. Here is the detail that creates the most missed applications. Most seniors with very low incomes who might qualify for this credit also have most or all of their income in the form of Social Security, which is excluded from the credit's calculation base. Because Social Security is subtracted from the base amount before the credit is calculated, seniors whose primary income is Social Security often find that the subtraction reduces the credit to zero or near zero. But seniors who have a combination of low taxable income from a pension or part-time earnings, limited Social Security benefits, and some federal income tax liability may find that the credit reduces their tax bill by $200 to $750, money they have been entitled to for years. A retired domestic worker in Mississippi, 69 years old, received $8,400 per year in Social Security and $4,800 per year in pension income, total income of $13,200. Her taxable income after the senior standard deduction of $16,550 was zero. She owed no federal income tax. The credit for the elderly or disabled did not benefit her because she had no tax liability to reduce. But her neighbor, also 69, also receiving $8,400 in Social Security but with $8,200 in pension income from a prior employer, had a small federal tax liability of $180 after the standard deduction. The credit calculation reduced her liability to zero. Her tax savings, $180. Not a large amount, but one that had gone unclaimed for 4 prior years because neither her neighbor nor her general tax preparer knew to look for it. In Mississippi, Alabama, and Arkansas, states with the lowest average senior incomes and the highest concentration of seniors whose income falls within the credit for the elderly or disabled phase-out range, the credit goes unclaimed at rates VITA program coordinators describe as consistent and persistent. Filing step number 4. The Earned Income Tax Credit for Seniors. The expanded eligibility that most eligible older Americans do not know applies to them. Prior to 2021, the Earned Income Tax Credit, one of the largest refundable tax credits in the federal tax code, it was generally not available to workers over 65 without a qualifying child in the home. The American Rescue Plan Act of 2021 made temporary changes to EITC eligibility for older workers, and subsequent legislation has extended and in some respects made permanent the eligibility of seniors without qualifying children for this credit. Here is the current eligibility structure for seniors in 2026. Workers age 65 and older with earned income, wages, self-employment income, or certain disability income, and whose total income falls within the credit's phase-out range are eligible to claim the EITC. For a single filer with no qualifying children in 2026, the maximum EITC is approximately $632 and begins phasing out at approximately $10,566 in earned income, disappearing entirely at approximately $18,591. These figures are modest, but the credit is refundable, meaning it generates a payment from the IRS even if the filer owes no income tax. Here is the population this provision most directly benefits. Seniors who are partially retired but continue to work part-time, at a retail job, at a caregiving or domestic services position, as a self-employed handy person or craftsperson, or in any other capacity that generates W-2 or self-employment income below the phase-out threshold, may qualify for this credit and receive a refund from the IRS, even if no taxes were withheld from their earnings and even if they owe no income tax on the income they received. Here is the dollar illustration. A 67-year-old woman who works 12 hours per week at a local grocery store earning $11.50 per hour receives approximately $7,176 in annual wages. She also receives $14,400 in Social Security. Her total income is $21,576. Her taxable income after the enhanced standard deduction of $16,550 is $5,026, primarily from the portion of her wages above the deduction. Her federal income tax on $5,026 at the 10% rate is $502. Her EITC, calculated on her earned income of $7,176 with no qualifying children, is approximately $428. The credit reduces her tax liability from $502 to $74. She owes $74 in federal tax rather than $502, a savings of $428 from a credit she was entitled to claim. Here's the additional detail that matters for seniors with self-employment income. Seniors who earn income through self-employment, selling crafts, providing services, farming, or any other self-employment activity can claim the EITC on their net self-employment income after the self-employment tax deduction. But the EITC qualification requires that the income be earned income. Pension income, Social Security, rental income, investment income, and most retirement account distributions do not count as earned income for EITC purposes. Only wages and net self-employment income qualify. A retired carpenter in North Carolina, 66 years old, earned $9,400 per year doing small repairs and handyman work in his neighborhood. Income he reported on Schedule C as self-employment income. He received $16,800 in Social Security. He had been filing his own tax return for years and had never been told he might qualify for the EITC. A VETA volunteer reviewing his return calculated his EITC at $312. The volunteer also identified that he had been eligible in the 2 prior years, both still within the amendment window. Amended returns for both prior years generated refunds of $289 and $304 respectively, a total recovery of $593 from 2 amended returns, plus $312 from the current year's return. In North Carolina, Virginia, and Tennessee, states with large populations of semi-retired seniors who supplement Social Security with part-time or gig economy income, the Earned Income Tax Credit for workers without qualifying children is identified by VITA program coordinators as among the most frequently unclaimed credits in their caseload of senior tax returns. Filing step number 5, the non-filer refund recovery, the IRS payment available to seniors who stopped filing because they believed they did not have to. This is the one. This is the filing step that generates the most surprise and the most immediate financial impact. For the seniors, it applies to, because it is not about claiming a credit on a return you are already filing. It is about filing a return you stopped filing because you believed incorrectly that your income was too low to require it, and discovering that the IRS owes you money even though you owe the IRS nothing. Here is the situation this applies to. Many seniors on very low fixed incomes, whose only income is Social Security or Social Security plus a small pension or Social Security plus modest investment income, reach a point in retirement where their gross income falls below the filing threshold for their age and filing status. For a single senior over 65 in 2026, the filing threshold is $16,550. For a married couple where both spouses are over 65, it is $32,300. If gross income falls below these thresholds, the IRS does not require that a return be filed. Most seniors in this situation stop filing. They believe they have no filing obligation, no tax owed, and therefore no reason to interact with the IRS. In most cases, on the tax liability question, they are correct. They owe nothing. But here is what most of them do not know. Not owing taxes and not qualifying for a refund are not the same thing. A senior who owes 0 federal income tax may still be entitled to receive a refund, a payment from the IRS. if they qualify for a refundable tax credit. And refundable credits produce payments from the government even when no tax was owed during the year. The most significant refundable credit available to low-income seniors who may not be required to file is the Earned Income Tax Credit, discussed in the prior section for seniors with earned income. But for seniors who had federal income tax withheld from a pension distribution, a part-time paycheck, or any other source during the year, and who stopped filing because they believed they owed nothing, the withholding itself may entitle them to a refund, because the withheld amount reduced their tax liability below zero from the IRS's perspective. Here is the mechanism. A senior receives a $14,000 pension distribution. The pension administrator withholds 10% federal income tax, $1,400, and forwards it to the IRS. The senior's total income for the year, including Social Security, is $30,000. After the senior standard deduction of $16,550, their taxable income is $13,450. The federal income tax on $13,450 is approximately $1,345. The $1,400 withheld exceeds the $1,345 owed by $55. The IRS owes the senior a $55 refund. The senior, believing they do not need to file because their income is below a threshold they imprecisely remember, does not file. The $55 refund sits unclaimed, not for a year, for 3 years, at which point the statute of limitations closes and the $55 cannot be recovered. Here is where the dollar figure becomes significantly larger. A senior who has had 10 to 20% withheld from pension distributions for multiple years, a common default withholding rate on pension income, and whose actual tax liability is zero or near zero after the senior standard deduction and applicable credits, may have overpaid through withholding by $200 to $800 or more per year for each year they did not file. At 3 years of unclaimed refunds, the maximum recoverable period, the cumulative overpayment can reach $600 to $2,400 that the IRS will return if a return is filed within the window. A retired seamstress in Georgia, 72 years old, had stopped filing federal tax returns in 2020 when her income dropped below what she believed was the filing threshold. She had received a small pension distribution each year of $6,000 with 10% withholding, $600 per year withheld. Her total income, including Social Security, was below $30,000 each year. She owed no federal income tax after the senior standard deduction, but the $600 withheld each year was recoverable through a filed return. A VITA volunteer identified the situation and helped her file returns for 2021, 2022, and 2023 as the 3 years within the recovery window at that time. Her combined refunds from the 3 years, $1,800, the withheld amount she was owed but had never claimed because she did not know filing below the threshold could generate a refund. In Georgia, Mississippi, and South Carolina, states with large populations of low-income seniors receiving small pension distributions with default withholding, the non-filer refund recovery opportunity is identified by VITA coordinators and AARP tax aid volunteers as among the most impactful single filing actions available to their senior clients. Here is what you do this week. Step 1. Pull your federal tax returns for 2022, 2023, and 2024 and check the standard deduction line on each one. If you are single and over 65, the standard deduction for 2024 should be $16,550. For 2023, it should be $15,700. For 2022, it should be $14,700. If any year shows the base non-senior figure, that year's return may be understating your deduction. Note every year where the additional senior amount appears to be missing and bring those returns to a VITA site or tax professional for review. Cost free. Potential recovery per year up to $429 at a 22% marginal rate. Step 2. Add up your unreimbursed medical expenses for the current tax year, including Medicare premiums from your Social Security statement, supplement premiums, prescription drug costs, dental and vision costs, and long-term care insurance premiums. Compare the total against 7.5% of your AGI. If the excess is large enough, combined with property taxes and other potential itemized deductions, to exceed your standard deduction, inform your tax preparer before filing that you want to compare itemized versus standard deduction results. Cost, free, potential savings, $200 to $1,500 or more in years with significant medical expenses. Step 3. If you have any earned income, wages, self-employment income, part-time earnings, ask your tax preparer specifically about the earned income tax credit for workers over 65 without qualifying children. If your earned income is below approximately $18,591 as a single filer, you may qualify for a credit of up to $632 that is fully refundable, meaning it produces a payment from the IRS even if you owe no income tax. Ask the same question for any prior year still within the amendment window in which you had earned income. Step 4. If you stopped filing federal tax returns in any year since 2022 because you believed your income was too low to require a return, contact a VITA site or AARP tax aid location this week. Find your nearest VITA location at irs.gov/VITA or by calling 1-800-906-9887. Bring any income statements, Social Security benefit statements, 1099-R forms from pension distributions, W-2s from any part-time work from the years you did not file. Ask the volunteer to determine whether you had any withholding from those income sources that entitles you to a refund and whether you had earned income qualifying you for the EITC. The 2022 refund recovery window closes April 15, 2026. Act before that date. Step 5. For every prior year tax issue identified through steps 1 through 4, file Form 1040-X for each year still within the 3-year amendment window. Mail the amended return by certified mail with return receipt requested to create a postmark record proving it was filed before the deadline. Keep a copy of every amended return and its mailing receipt. Processing time for amended returns is 16 to 20 weeks. Plan accordingly, but do not wait. The postmark date, not the processing date, is what determines whether the refund claim is timely. You paid your taxes honestly for your entire working life. You withheld what was withheld, paid what was billed, and trusted that the number on the return was the right number because you did not know what you did not know. And in the years since retirement, when the income dropped and the complexities changed and the forms got harder to understand alone, you may have overpaid. Not because you made a mistake, because the tax code contains provisions designed specifically for you that nobody told you to claim. The IRS does not send a letter that says your refund is waiting. It does not call to say the amendment window is closing. It does not flag your account when a credit you qualify for goes unclaimed year after year. It processes what you file, it keeps what you do not claim, and the window to claim what is yours, 3 years from each original filing deadline, runs on a clock that does not pause for illness, for grief, or for the simple fact that you did not know the credit existed. You know now. And for 2022, the clock runs out on April 15th of this year. Your family should not discover after you are gone that the IRS held refunds you were entitled to for years because the return was never filed. Your spouse should not learn that 3 years of overpayments could have been recovered if someone had reviewed the returns 12 months earlier. The VITA site is free. The amended return is free. The process takes a few hours. And the refund, when the IRS processes it, arrives as a direct deposit or a check in your name for money that was always yours. Take action this week. Protect what you built. If you know a senior who stopped filing tax returns because they believe they owed nothing, or who has been filing for years without a professional review of whether every available credit and deduction has been claimed, share this video with them today. The 2022 refund window closes April 15th, 2026. The time to act is now. Next week, we are covering the one Social Security decision that most surviving spouses make incorrectly under grief, and the specific claiming sequence that elder law advocates say costs affected households an average of $62,000 in lifetime benefits when it goes uncorrected. You will not want to miss it.